Looking for a mortgage? Sean Cooper takes us through a checklist of everything you need to know when shopping for a mortgage. Whether it's your first or you're up for renewal and want to find the right mortgage for you. Sean is my go-to mortgage expert. He paid off his mortgage at 30 years old. Now he's the best-selling author of Burn Your Mortgage, and he's also a mortgage broker. Welcome to the MapleMoney Show, the podcast that helps Canadians improve their personal finances to create lasting financial freedom. Not only does our sponsor Borrowell provide a credit score, but they now give you free credit reports as well. Check for any inquiries about your credit, your trades, and accounts, and to see what you have owing. I find this much more actionable than the score, and have reviewed my credit report in the past and cleaned up a couple incorrect items before looking for a mortgage. Head over to maplemoney.com/Borrowell today. Here's Sean's mortgage tips. Hi, Sean. Welcome to the Maple Money Show.
Hi, Tom. How are you doing?
Good. How are you?
Pretty good, thank you.
I'm glad to have you on. You're sort of my mortgage expert. You paid your mortgage off at 31, was it?
Actually, I set the goal of paying it off by 31, but I actually managed to do it by 30.
That's right. Yeah. So I was hoping you can just give the listeners here some mortgage tips. So starting right at the beginning, if someone's looking into buying a house, maybe it's their first house, maybe they're looking for a new house. What's that first step? Like, should they get pre-approval? And is that even a real thing? Because I thought I heard there was a catch, like you're still not totally approved.
Yes, so getting pre-approved for a mortgage is definitely helpful because a lot of real estate agents won't even work with you unless you're pre-approved because they want to know how much you can actually go out and spend on a property. So being pre-approved for a mortgage is a good first step. There's also being pre-qualified, and if you're actually serious about buying a property, I would encourage you to be pre-approved because pre-qualified is just basically entering some basic information on a lender's website, and then they kind of spit out a number. So being pre-approved is kind of the next step, and if you're more serious about buying a property. So when you're pre-approved for a mortgage, then you have that all-important number in terms of how much of a mortgage you can afford under the current mortgage rules, and that includes your income and down payment, and you basically have a number to work with. So depending on what your income and your down payment is, and if you're buying with a partner or whatnot, let's say you could go out and spend $500,000 on a property. Well, of course, that would depend on what market you're buying in, but at least you can kind of hone in on certain property types. So if I'm buying in a market like, let's say, Winnipeg, then I could perhaps afford a detached house. But if I'm trying to buy in a market like Toronto, $500,000 is definitely not going to cut it. So it kind of helps you hone in on those choices and use your time and the real estate agent's time in a good way. Now, as you were mentioning about a pre-approval, I've heard people say that a pre-approval isn't worth the paper that it's written on, and I agree with that to a certain degree. Now, a pre-approval is definitely helpful, but it's important to take note that you're only the lender only knows part of the story. So they know your income and your down payment and your credit information, but the missing part of that story is the actual property. So they don't actually know the property that you've bought yet. So you could buy a property where the lender doesn't like it. There could be any number of reasons why they don't like it. It could be because of the location of the condo unit that you're buying. Perhaps it could be like in a work-live location and the lender doesn't like that. Or it could also even be because of your neighbor's property. I've actually heard of lenders refusing properties because they don't like a neighbor's property nearby. So the missing piece of the puzzle is the property. So to protect yourself, I would encourage you to make your offers conditional on financing because you never know what reason that the lender could perhaps refuse to lend to you. And if you don't have any conditions at all, then you can lose your deposit and get sued. So certainly not a good position to be in. So the lesson of the story is do condition of financing. And if you're in a multiple offer situation, I understand that you're under pressure, but I don't think it's worth being sued by the seller of the property just to waive that and try to get the property. Perhaps consider another property instead. So yeah, definitely it's important to include that condition to protect yourself, Tom.
Nice. That's a good point. The thing I was thinking there too was to get approved for more. Not that you necessarily just want to get approved for as much as possible, but I would think getting a good rate would be helpful. How much does you mentioned credit score? How much does that come into play?
Credit score is definitely important. For example, lenders have different credit score cutoff levels. Like generally, they want a credit score over 680. So if you have a lower credit score, then you might not be able to get the best mortgage rate. And of course, that will cost you more mortgage interest over the long term. And if your credit score is so low, like even below the 600s, then you probably can't qualify with like an A lender, a prime lender, like the best lenders out there. So you might have to go with an alternative solution or even a private lender, and that will cost you a lot more in the long run. Like with a private lender or alternative lender, you could end up spending double digits in interest. So your interest rate could be over 10%, and you might have to pay a lender fee as well. Like generally when you're working with a mortgage broker, you don't have to pay a mortgage broker any fee. But if you're working with like an alternative lender or private lender, then you might have to pay a fee to the broker and the lender themselves. So it's just best to avoid that situation if possible, and basically be responsible with your credit. So anything that you buy in your credit card, just make sure that you can afford to pay it off in full and on time, and basically treat it like cash. And I could go on for hours about this, but basically use credit responsibly, and you don't have to know all the ins and outs of how your credit score is calculated, but just try not to use too much of your credit utilization. Otherwise, you can kind of get in hot water and damage your credit score. And of course, you can get your credit score for free online through various websites. So just kind of keep an eye on that. And I'd recommend pulling your credit score at least 6 months in advance of when you're thinking about buying a property. That way, if it's lower than you anticipated, you can kind of take steps to make your credit score better, and then you can get a mortgage with an A lender and not even have to deal with a private lender or an alternative lender.
Mm-hmm. Those are good tips too. Even in general, if you're putting money on a credit card, not paying it off, it's not just hurting your credit score, but you're wasting all that money in interest.
Exactly.
There's no winning at all with that. Now you mentioned fees, and another fee that comes to mind is the CMHC fees. I've always tried to make sure, or I've always made sure that I put the 20% down at least, just because I don't want the extra fees. I'm not even sure off the top of my head what those fees, how much they are right now. But can you give us a little info on those?
Sure, definitely. As you mentioned, if you put less than 20% down on a property, then you'll be required to pay mortgage default insurance. Now, people that hear mortgage default insurance and they think, oh, I'm protecting myself, but that insurance is actually to protect the lender if you fail to repay your mortgage and run into financial difficulties later on. Now, people kind of think, oh, mortgage default insurance is a cash grab, it's no good. But the thing is, without mortgage default insurance, the mortgage rates, if you're putting down less than 20%, would probably be a lot higher, and the lenders might not even allow less than 20% down payment. And I don't know about you, but trying to buy in the Toronto market without a 20%, like with a less than like if you had to save up to 20% down payment at least to buy a property in Toronto, good luck with buying a house if it's over $1 million. I mean, that'd be pretty difficult. So mortgage default insurance is good because it helps you get a lower interest rate. And something funny and that I found out as being a mortgage broker is the advantage about mortgage default insurance is you typically get a better mortgage rate when you put down less than 20%, as opposed to if you put down, like, let's say 25%. It's because the lender is protected by this mortgage default insurance. And kind of a fun fact is if you put down more than 20% and your mortgage is insurable, basically your lender is paying the like default insurance. You're not paying it yourself, but yeah, generally the sweet spot, if you're putting down more than 20%, is a 65% loan to value. So that means 35% down payment. So if you have at least a 35% down payment, then typically your mortgage rate is the same for somebody that's putting down less than 20%. But yeah, mortgage default insurance, generally you have the choice of either adding it to your mortgage and kind of having it amortized over the life of your mortgage, or you can pay it off all at once when you're moving into your house. But I don't really know anyone who can afford to do that unless you win the lottery. But yeah, it's a good way to get into the market if you're buying in an expensive housing market. But I'd say if you're buying in a more affordable market like Winnipeg, then try to aim for that 20% and avoid it altogether, because it certainly can add up to a lot of additional costs over the life of your mortgage.
Mm-hmm. I had sort of seen that sometimes the fees were less under 20%, and I, or not the fee, but the rate you get. But I was thinking maybe the fee kind of offsets that a bit, right?
Yeah, the fee does help with that. And as I mentioned, like lenders might not even be comfortable like offering as little as 5% down. So it definitely opens up the housing market to people that I like to call marginal buyers that are kind of buying a shoestring of 5%. So I certainly think it's good, because good luck coming up with a 20% down payment in Toronto or Vancouver. You would be saving for years. Like if you look at average income levels, like probably take you over like 10 years to save up a down payment. So I'm certainly glad that mortgage default insurance does exist, because it does let
Yes,
people
for
into
sure.
the housing market that couldn't get in normally.
Yeah, and like any insurance, it's really it's all about sort of the stats with risk, right? Like if the bank perceives you as a higher risk because you have 5% down, then they insure through you to kind of reduce that risk.
Exactly.
The only other thing I could think of when it comes to sort of the ability to get a mortgage is uh, the other debt you have and your household expenses. There's different ratios for that, right?
Yes, that's correct. So there's two main ratios that lenders look at in terms of your debt. They look at the GDS ratio, the gross debt servicing ratio, and the TDS ratio, the total debt servicing ratio. The GDS ratio basically looks at your income versus the principal, interest, taxes, and heating. So the acronym for that is PITH for those four expenses there. And they basically look at your gross annual income versus that. And lenders are generally looking for a ratio of 39% on the GDS. Now, on the TDS side, it looks at the exact same thing, your gross income versus your principal, interest, taxes, and heating. And I forgot to mention 50% of condo fee if you have a condo there. But it also looks at any other debt you might have. For example, if you have a student loan, line of credit, car payments, those are added into it as well, because it definitely hampers your ability to pay a mortgage if you have other monthly debt obligations. So it factors them in, and generally lenders are looking for a TDS ratio of 44% and under now. That's just a general guideline. There might be able to be some exceptions, but just with kind of the government clamping down on the mortgage industry nowadays, a lot of lenders are kind of being less flexible with those. So certainly if you have 39 and 44% or the GDS and TDS respectively, then that's good. And it's also kind of to protect yourself as well, because you don't want to overstretch yourself in terms of your finances and buy too much house, because certainly if interest rates go up and your mortgage renews, then your payments could be higher. So I think that's a good way to protect yourself and avoid being house rich and cash poor, because I don't know about you, but I certainly don't want all my money to go towards my mortgage and never be able to afford to take a vacation or have any fun. I certainly would think that my spouse, if I had one, wouldn't be very happy if I did that. So certainly I think it's good to stay within those guidelines that exist with the TDS and the GDS ratios.
So if those are relatively hard ratios, does that mean it's probably more important to pay off your debt than have additional down payment? Like say I had $10,000 extra just before I was about to buy a house, would it be better off to pay off some debt if it helps improve those ratios?
Now, in personal finance, I don't mean for this to be a cop out, but it definitely depends on the scenario. So that's why it's so important to speak with a mortgage broker to help them run the numbers, because they can kind of take a look at what the numbers would look like if you were to pay off that debt before you get the mortgage, or if you were to put that debt towards the down payment. So it really depends on the purchase price of the property that you're trying to hone in on, as well as your down payment amount and income amount. So definitely run the numbers with a mortgage broker, and they can kind of help you come up with a good game plan if you're not in the place where you want to be in terms of the purchase price. So yeah, it really depends on your own personal situation.
Okay. One of the best ways for me when I had my first down payment was I used the home buyers plan, and a lot of people might not know about that. Could you go into that a bit?
Sure. So under the home buyers plan, you're able to withdraw up to $25,000 from your RSP tax free. Now, if you're buying with a spouse, that's a combined $50,000 that you're able to withdraw. Now, while that's a great program, you just have to make sure that you follow the rules. So any money that's withdrawn has to be repaid in equal installments over a 15-year time period starting in the second year. And if you fail to do that, not only will you lose the RSP room forever, it will be included as taxable income. So certainly make sure that you follow the rules. And when you're initially taking out the money, make sure that you speak with your lender, whoever the RSP is with, because if you just take the money out of your RSP without actually filling in the correct tax forms, then it's going to be considered a regular RSP withdrawal, and you'll lose the room forever, and you'll face hefty withholding taxes. So definitely make sure that you do that. I mean, some people might think that it's a bit of a no-brainer that you need to fill in these tax forms, but you'd be surprised about some of the stories I've heard where people actually take the money out and they think, oh, I can go back to my lender and just tell them it was for the first time home buyers plan. But you kind of get into murky waters, and some lenders might be okay with correcting it after the fact, but I've certainly heard of other lenders who weren't okay with that. And certainly with the government, again, clamping down on the mortgage industry and like the regulators keeping a close eye on the financial institutions, they're not really as lenient as they used to be. So certainly make sure that you follow all the rules of the home buyers plan, and you should be fine. But I definitely think it's a great way to get into the market because you can save that money and then withdraw it without paying any taxes, and you can basically reach your down payment goal a lot sooner. So certainly it's worth exploring if you're a first-time home buyer.
Mm-hmm. Speaking of mistakes with the home buyers plan, I've got one to admit.
Okay.
I did find when I filled out the form with the bank and everything, this was quite a while ago now. But the very first year that it was due, I forgot to claim on my taxes
Oh, darn it.
that 1/15th or whatever it is, it was to go to home buyers plan. So I ended up paying income tax on it on that fraction, because it was just considered extra income that year. And when you don't claim it, it's like you just pulled it out normally. So it was a small amount just for the 1 year, but yeah, you certainly have to make sure you're following everything.
Exactly. Just make sure you dot all your I's and cross your T's. But it's a great program. Just make sure that you understand the basic rules of it and follow them, and you should be fine.
Mm-hmm. How about years of amortization? Off the top of my head, I'm not even sure. Is it 25 years the maximum now? It's changed a couple times since I first got my mortgage.
Yeah. So back in the day, you used to back before the financial crisis happened in 2008, you could get up to a 40-year amortization. So that was pretty crazy in my opinion. Like imagine having a mortgage for 40 years, you'd definitely be paying a lot of interest, that's for sure. But it's basically the maximum for an insured or insurable mortgage, which basically means that the mortgage insurers like CMHC, Genworth will cover it, is 25-year amortization. But with some lenders, if you're putting more than 20% down, you can get a 30-year amortization. So that still exists. And I think you might even be able to get more than that. But you just have to remember a lower amortization means, like basically amortization is the length of time that it takes you to pay off your entire mortgage. So the advantage of a longer amortization is that you'll have lower mortgage payments. So it helps you in terms of cash flow. But what doesn't help you is that the interest is compounding even faster, and even stretching your amortization out by 5 years can cost you a lot of money in interest. So certainly run the numbers, and a 30-year amortization is an option, and it's actually what I did myself. But what I did it in terms of cash flow flexibility. But then what I did was I took advantage of all those prepayments, like I doubled up my payment and made lump sum payment and increased my regular payment. That way I was able to pay off my mortgage in only 3 years with a 30-year amortization. So if you're somebody that's financially disciplined and you're motivated to burn your mortgage similar to me, then a 30-year amortization can be worth looking into in terms of the flexibility of cash flow. But if you're somebody that you're just going to pay the minimum payment and you're not as financially disciplined, then perhaps it's better to go with a 25-year amortization, because lenders do typically charge you a premium to go with a 30-year amortization. You might have to pay a mortgage rate that's 0.05% higher, or like 0.1% higher. So it more likely will cost you. So I would say typically go with a 25-year amortization, unless you're super financially disciplined and you're like a single income household and you're just worried about the cash flow if you ever lost your job. Then 30-year amortization might be worth it. But yeah, I'd say 25-year amortization is worth it. And if you make those prepayments, then your amortization is going to be cut, and when you renew your mortgage, you'll won't necessarily be 20 years. It could be even less than that, like 17 and a half years, or less than that. So that's just kind of your starting point. But yeah, 25 years is generally the maximum for an insured or insurable mortgage.
Okay. And I like the idea of doing less years if you can, because a lot of people aren't sort of able to make those prepayments just mentally, like they don't put their money there. But if you go with a smaller term, then it's or amortization, sorry, if they go with smaller amortization, it's sort of forced savings. Like not only are you not paying that extra interest, but you're kind of putting more money away quicker, and having to.
But just a word of caution, I've heard people where normally they could get a 25-year amortization, but they're like, I want to pay down my mortgage even faster, so I'm going to go with a 15-year amortization. But I'm not sure that makes the most sense, because if you were to lose your job, then you'd be stuck with those really high mortgage payments. And I don't know about you, but when you lose 100% of your income, it can be very difficult. So I'd rather have the flexibility of like a 25-year amortization and having the ability to double up and make prepayments and lump sum payments. That way, if you want to pay it off sooner, you can, and you're not really forced to pay that higher payment. So that's my own personal preference.
And that's a good reason to have a mortgage broker too, is that you can make sure you're getting a mortgage that allows you to do all that. Like I know
Exactly.
there's different rules, right? Like some allow more to be paid off in a year than others, right?
Exactly. Like the prepayments vary between different lenders. Some people just assume that it's the same with all lenders, but that's definitely not the case. So the prepayment privileges and amounts can vary between lenders. For example, one lender might allow you to make a 10% lump sum payments over like in a year, and other lenders might allow you to make 15% or 20%. So if you want to aggressively pay down your mortgage, then if the rate's the same, you might want to go with the lender that offers the 20%. And on the topic of lump sum payments, some lenders only let you make that lump sum payment once a year on the anniversary date, but other ones actually let you make it throughout the year. And as long as it totals up to 15 or 20% or whatever the limit is, then they're okay with that. So definitely want to read the fine print. And that's why it's so important to work with a broker, because they can kind of assess your needs, and then they're like basically a mortgage matchmaker. They can kind of match you with the lender that has the best mortgage out there, and they probably deal with like 30 different lenders at least, so they can kind of find the lender that's the best fit for you based on what you're looking to do with your mortgage. So certainly there are doubling up of payments and increasing your payments and lump sums and all that jazz, but it definitely definitely varies by lender. So if you work with a good broker, they can kind of match you up with a lender that makes the most sense for you. And people just think it's all about getting the lowest mortgage rate. And while mortgage rate matters, there's definitely other factors like those prepayments and penalties and portability and other stuff that you need to be concerned about.
Great. Is there one more tip or anything that you might think that people could benefit from that maybe we haven't covered?
Sure. So I just kind of touched on it in my last answer. So many people are focused on getting the lowest mortgage rate when they're shopping for a mortgage. Now, what I like to say is the lowest mortgage rate can save you hundreds, but the wrong mortgage product can cost you thousands. Now, when you're going to the supermarket, and I like to use this analogy to shop for bread, you're not just going to buy the cheapest loaf of bread and with the highest level of sugar and not consider stuff like nutritional value and dietary fiber. I mean, I hope that you wouldn't do that, but and the same thing with the mortgage. Like, you could certainly shop for the mortgage with a lower rate, but it might have stuff in the fine print that doesn't really benefit you. So you might get a lower rate, but it might not have very flexible prepayment privileges. Like, you might not be able to pay down your mortgage quickly if that's important to you. And it might have strict mortgage penalties. Like, people don't consider the mortgage penalties when they break their mortgage. So a stat that I just wanted to throw out there, Canadians love 5-year fixed rate mortgages. We sign up for them in droves. That's the most popular option. But something that might surprise you is 6 out of 10 Canadians actually break their 5-year fixed rate mortgage before the end of the term. So if you ask those people up front when they're signing up for their mortgage whether they're going to break it, I bet all 10 of them would say no, but something comes up, they might lose their job or decide to relocate to another part of Canada, or unfortunately they might get separated or divorced. So there's all sorts of things that can lead to that. So certainly it's important to consider your mortgage penalties and choose a flexible mortgage that's kind of going to work for you. So if you're like, for example, an RCMP officer and there's a good chance that you're going to be relocated, certainly choose a lender that has a flexible portability feature and also has fair mortgage penalties. And if you might move to another province, then a credit union probably doesn't make sense because those generally just operate in provinces. So again, by working with a knowledgeable mortgage broker, they can kind of help match you with the right lender who will make sense in terms of your own personal financial situation. So just to recap, don't just shop for mortgages based on rates. There's so many other things to consider. I like to call them the 3 mortgage P's. So penalties, prepayments, and portability. Make sure you consider those factors there, because if you just shop for the lowest rate, then it can come back to bite you later on if you have to break your mortgage. Because I don't know about you, but don't really enjoy spending $20,000 on a mortgage penalty, but unfortunately I've heard far too many stories of people doing that because they just didn't take the time to read the fine print when they signed up, and then they kind of get surprised down the line. So certainly take the time to consider all those factors and work with a good mortgage broker, and you should have a better chance of being matched up with the right mortgage for you that will benefit you long term.
Sounds good. Can you let everyone know where they can find you?
Sure. So if you'd like to reach me, you can visit my website. It's seancooperwriter.com. That's Seancooper writer.com. And I'm also a mortgage broker. So if you could use any unbiased mortgage advice or second opinion, you can call me on my phone number or text me 647-867-3711, and you can email me as well, seancooperwriter@gmail.com.
Great. Thanks for being on the show, Sean.
Well, my pleasure, Tom. Thank you for having me.
Thanks for listening, and thanks to Sean for the mortgage advice. You can find show notes for this episode at maplemoney.com/Sean Cooper. Are you a new listener? Please be sure to subscribe in the app of your choice. Simply search for Maple Money in iTunes, Google Podcasts, Spotify, and more.